passive dividend investing versus active dividend growth strategy, or holding stocks versus building income. I've been interested in investing since around 2006, and for a long time I thought I had just two options: either buy some ETF and forget about it, or actively follow the markets and chase the highest dividend yield I could find. Today I know it's not that simple. The passive approach is simple. You choose quality dividend stocks or a solid dividend ETF. You invest regularly, maybe the same amount every month. And then you let time do most of the work. You don't need to watch the market every day. You don't need to react to every headline. You reinvest the dividends and allow compounding to build slowly in the background. But the key is patience. This is a strategy for years, not months. The active dividend growth approach goes a step further. You're not just buying anything with a dividend. You look at how fast the dividend is growing, whether it's sustainable, what the payout ratio looks like, how much debt the company carries. You rebalance. You remove weak positions. It takes more work, but the results can be very different. Let me show you a simple example. An investor starts with $1,000 and adds $100 every month. Over 20 years, that's a total contribution of $25,000. With a passive approach, a 2.5% net yield and 7% annual portfolio growth, the portfolio could grow to around $55,000. That would produce roughly $114 per month in dividends. With an active dividend growth approach, a 5% net yield and 11% annual portfolio growth, the portfolio could reach around $89,000. That's about $370 per month. Same time, same discipline, very different income. Now, let's look at a bigger starting point. An investor starts with $10,000 and adds $300 every month. Over 20 years, total contributions come to $82,000. With the passive approach, the portfolio could grow to about $197,000. That gives around $410 per month in dividends. With the active dividend rotation approach, the portfolio could grow to around $349,000. That means roughly $1,454 per month. Same time horizon, same discipline. Also, very different income result. Why the gap gets so big? The difference doesn't come from magic. It comes from a combination of higher income today, faster dividend growth, and reinvesting that income over time. That's what compounding really looks like in practice. A portfolio with a stronger income base can start building its own momentum. And over long periods, even a few percentage points can completely change the outcome. This is where I try to improve the classic DCA approach. I still invest regularly and reinvest dividends, but I also trim positions after strong gains and rotate that capital. My approach starts where classic DCA ends. It's not enough for me to just add money regularly and wait for dividends and time to do all the work. When a stock grows significantly, I take part of the gain and move that capital where I see a better yield, lower risk, or stronger future dividend growth. That's how I try to reduce dead capital and improve the efficiency of the whole portfolio. The difference compared to a passive approach may not show up in year one, but after 5 or 10 years, it can be significant. That rotation is what adds the extra momentum. A passive portfolio grows through contributions, dividends, and market growth. Mine does all of that too, but on top of that, it recycles excess gains back into higher yielding positions. So instead of letting overvalued positions sit and do less work, that capital keeps compounding at a higher rate. That's the real reason for the difference. Not a higher risk profile, just better use of the capital that's already there. This checklist is what stops me from making emotional decisions, chasing yield, or buying something just because it looks cheap on the surface. This is the part of investing that I think many people underestimate. It's not only about adding money every month, and it's not only about collecting dividends. For me, the real difference comes from what happens after a position has already done well. So my strategy is still based on DCA and dividend reinvestment, but I add one more layer: capital rotation. And over time, that can make a huge difference. Because the goal is not just to own more stocks, the goal is to make every dollar in the portfolio more productive. Let's compare two approaches starting from the same point. Scenario A is a passive dividend strategy: $10,000 to start, $300 added monthly, a 2.5% net dividend yield, and 7% annual growth. Scenario B uses the same starting capital and the same monthly contribution, but adds trimming and capital rotation. That increases the portfolio's efficiency to 5% net yield and 11% annual growth. So the difference is not the starting point. It's not the monthly contribution. The difference is how efficiently the capital is managed. Now, I want to be straight with you. This is not a guarantee of outperformance. Markets don't work that way, and neither does any strategy. But when you apply this kind of discipline consistently, over years, it can meaningfully accelerate compounding. And it can help you reach a higher monthly dividend income faster than simple buy and hold forever. The key word is consistency. One good rotation doesn't change much. 10 years of disciplined rotations can change everything. And the goal isn't to beat the market. The goal is to reach financial independence through dividend income faster. That's what I'm trying to build. If even one idea from this video helps you grow your dividend income faster, then it was worth making. These videos help me share my thoughts more clearly and connect with investors outside my language. Thanks for watching.